I guess it's like going to a dentist, right? My next guest says we have to endure it. And we're talking about this volatility, at least for now, but don't worry, things will return to normal. So let's bring in now BNY Wealth Chief Investment Officer, Sinead Colton Grant. And you say, well, we've seen this play out over many times before. Volatility now, normalization later. And these are the sort of things that we're looking at near term to sort of fade away at some point, right?
That's right. And so what's triggering a lot of volatility right now is clearly the situation in the Middle East and specifically the inflation concerns that generates. But what we expect is, this probably is resolved within a few weeks, in which case then the question becomes, what's the longer term impact on inflation? We suspect it's going to be much higher outside the US than here in the US, which is essentially energy independent.
So we get shipping starts to resume. That's the first thing, right? A couple of ships go through the Strait. I think market rejoices, right? I think that we could see that just from that one headline that turned everything around. I think it was yesterday. Oil prices began to retreat. We went from 120 to 80. We'll probably drift down from here. They don't go down as fast as they go up. And the market's refocused. What are we refocusing? Sort of on the more fundamental aspects of what's happening here?
Yes, and now some of this is linked, right? Because even though energy prices are, WTI is around $90 right now, that's still up from 65, more or less, where it was previously. So it's not to say there won't be zero impact on inflation. So that's a little bit why there was not much reaction to the inflation print today. But when you refocus, you've got to refocus on the fundamentals, and that's earnings and interest rates. And here's why we think the outlook is really strong for the rest of the year. So first of all, earnings. We expect earnings are going to expand by 13-14% over the course of the year. That gives us a year-end target for the S&P that's 7,600 at the end of the year. Right. It's also going to be a year where we see a significant consumer boost through tax refunds. The latest estimates are that we're going to see a boost of around 160 billion coming into the economy over the next couple of months. And then lastly, interest rates. We still expect that the Fed is going to cut rates 1 to 2 times, so another 25 to 50 basis points. You take all of that together, it's good for the stock market, and it's good for the economy. So we expect the US economy will expand by somewhere in the 2.2 to 2.3% this year. That's above trend. Trend growth is 2%. So the economy is firing. We think the stock market fires too.
Right. And this broadening earnings, it feels like, and maybe we just kind of gotten used to it, but the earnings reactions have been somewhat muted. In other words, I believe as they broaden out and you get some of these areas and some of these sectors that hadn't had these great earnings numbers, maybe they'll be the ones that get the big boost, the big reactions to it that, again, help us take us to that 7,600 target.
And what we've seen so far this year, if you looked at the headline number in terms of what the S&P has done, it's not much for the first 2-3 months. But underneath that, there's a lot of change, right? Where tech leadership has receded, you've had the other sectors come forward. That's actually the sign of a healthy market. And what we expect is that you're going to see more of the increase in the S&P driven by earnings growth rather than multiple expansion, because multiples are already pretty elevated.
Okay. And this is, there's a lot of different schematics out there on job losses, potential job losses. Now, this is from Anthropic, which I think is interesting because Derek Claude is the one killing some of these jobs. So folks, where the blues gets closer to the rim, those are the most in danger. So it would be office, legal, arts, life sciences, architecture, computer math, business, management. That's why the computer math is why your nephew can't get a job. He's been out of college 2 years. They told him the code, it was wrong. How much of this, though, do you think will be reality? Because the blue line is theoretical, and a red line, orange line is just what's been observed so far. And they're far different.
They are, and that's a really important point, right? In theory, everything is great, but what actually works in reality? We will see a number of use cases coming through over the next couple of years. Look, in terms of market reaction, we've seen the SaaS apocalypse, we've seen the impact on wealth management firms. And I think the key thing here is the market overreacts. They extrapolate from 1 or 2 research reports into, okay, that's it, everything is over. Now, that's not to say there isn't an impact on the jobs market already. You mentioned graduate hiring, that entry level, less experienced area is where we're seeing it. But for more experienced hires, that is not tailing off. That jobs growth is not tailing off. And I can tell you what we do at BNY. So we already have a number of digital employees, over 100 in fact. And where they're focused is on very repetitive tasks. And what's happening is it's freeing up our employees to focus on higher value add activities. And if you think about that on a larger scale, that means greater productivity in the economy overall. And the last point is, whether you think about, the steam engine, the car, I mean, take your pick, right? All of those were accompanied with the narrative of all jobs are gone forever, almost all jobs. That's never the reality. It's the timing where some jobs do go away before the new ones come.
I tell people I am a natural born Luddite. Like Ned Ludd, I would have broken a weaving machine thinking it was going to take all the jobs. To your point, every industrial revolution created more jobs, better paying jobs, and a better society. It just feels like this one might not. I got just 30 seconds, but I have to squeeze this in because we're talking AI. The other part of the AI stories, the CapEx, the spending, is it too much? Oracle had a really strong number, but their CapEx numbers are through the moon. People say you never get a return on investment. What are you thinking there? Are they investing too much in this?
Well, look, clearly it's something we're watching very closely. What was great about the Oracle numbers today, very strong print overall, particularly in the cloud businesses. But the CapEx number, despite their lift to growth expectations, the CapEx number stayed around 50. So what that means is higher profitability moving forward. And that really is the key.
Yeah. Sinead, thank you so much. Appreciate it.
Great to be here, Charles.